last year's course, I discussed how recent developments pertaining to EMIR have impacted centralized and bilateral clearing of derivatives. While introduced back in 2012, EMIR has been updated many times. Today, I will be focusing on a recent update known as EMIR Refit. In case you want to familiarize or remind yourself of the full EMIR legislation, you could look at last year's course materials. The European Market Infrastructure Regulation, also known as EMIR, entered into force in 2012 and brought about significant changes in the derivative space, covering clearing, reporting, risk mitigation, margin, and collateral exchange. The regulation has affected a large number of firms that are still wrestling with the requirements it introduced. Between 2015 and 2016, the European Commission conducted an extensive review of EMIR and its impact on the industry. The Commission found that although no fundamental amendments needed to be made to the core requirements under EMIR, the legislation could benefit from amendments on certain aspects in order to reduce disproportionate costs and burdens on the counterparties without compromising the objectives of the regulation. The agreed amendments, known as EMIR Refit or EMIR 2.1, will lead to some substantial changes. For example, key changes include the concept of a small financial counterparty that will be exempt from clearing and the introduction of specific requirements around the accessibility and affordability of clearing services. EMIR Refit came into force on June 17, 2019. In this course, I will summarize the key EMIR Refit changes and how they may affect firms. Slide 1 provides an overview of the main changes implemented under EMIR Refit. In the remainder of the course, I will discuss what these changes mean for the clearing obligation, margin requirements, and reporting obligation. EMIR distinguishes between financial counterparties and non-financial counterparties. This classification determines the set of obligations that apply to an entity. Financial counterparties, also known as FCs, are broadly defined as entities authorized under one of the European Union Financial Services Directives. Examples include a MiFID authorized investment firm or a bank. Non-financial counterparties, also known as NFCs, are defined as entities established in the European Union that is not an FC. An example of an NFC is an airline company hedging its exposures. Depending on the notional value of their derivative trading positions, NFCs can be either an NFC plus, which are subject to the clearing obligation, or NFC minus, which are not subject to the clearing obligation. As can be seen on this slide, one of the changes under EMIR Refit is that the definition of financial counterparties was extended to capture European Union alternative investment funds, irrespective of the location of the alternative investment fund manager, and where relevant, the European Union Alternative Investment Fund Managers. In this course, I will refer to the alternative investment funds as AIFs and their managers as AIFMs. This also has an impact on the EMIR classification of non-European AIF with a non-European Union AIFM. Originally, such non-European Union AIFs were classified as third countries entities that would be non-financial counterparties if they were established in the European Union. However, from June 17, 2019, non-European Union AIFs with a non-European Union AIFM will be reclassified as a third country entity that would be a financial counterparty if they were established in the European Union. One of the key impacts of this reclassification is that such non-European Union AIFs with a non-European Union AIFM will become subject on an indirect basis to the EMIR margin requirements when trading with a European Union dealer. This is the case even if such non-European Union AIF with a non-European Union AIFM had previously avoided the indirect application of those margin requirements by virtue of being a hypothetical NFC that was below the clearing threshold. The clearing obligation was introduced under EMIR as a means of reducing the operational and counterparty risk posed by uncleared over-the-counter derivatives in the most standardized asset classes. It was not long before many smaller market participants found complying with the obligation would lead to a significant increase in cost when engaging in the relevant asset classes. For smaller counterparties, clearing services can incur high fees passed on to them from clearing members, not to mention the further operational considerations required by providers of indirect clearing. Non-financial counterparties face challenges that they had not experienced before. Many smaller firms struggled with the burden of calculating thresholds on a 30 working day rolling average basis, and others fell foul of the large net cost caused by breaching any of the asset classes' thresholds. This left certain firms in a situation whereby their trading in a single asset class made their less frequent trades in other asset classes much more expensive, as they would become subject to the clearing obligation for all asset classes, not just the ones for which they breached the threshold. These issues were identified under the review of EMIR, and a number of changes are targeted at reducing the costs and mitigating the operational burdens of clearing. EMIR Refit changes both the clearing threshold calculation, procedure, and the implications for NFCs in the event that they do exceed a clearing threshold. If an NFC exceeds the clearing threshold, it will only become subject to the clearing obligation in respect of that asset class in which it has exceeded the clearing threshold. However, exceeding the clearing threshold in one asset class will make an NFC subject to the collateralization requirement in respect of all asset classes. Key changes to the clearing obligation are summarized on this slide. As can be seen on this slide, one of the key changes under Refit is the introduction of the small financial counterparty, also known as the SFC. An SFC is exempted from the clearing obligation, but will remain subject to the risk mitigation obligations, such as the posting of margin. The determination for whether an entity is an FC or an SFC will be made using the same clearing thresholds that apply to non-financial counterparties. However, the determination would only need to be made once a year and would be based on the aggregate month-end average of the preceding 12 months. In light of ESMA's statement issued in March 2019, this initial calculation must be made as of the day on which the Refit regulation entered into force. An FC that exceeds the clearing threshold for at least one asset class or does not calculate its positions would become subject to the clearing obligation in respect of the in-scope products across all asset classes. The positions need to be calculated at the group level or for UCITS and AIFs at the level of the funds. I will now discuss what these changes mean for the clearing obligation, margin requirements, and the reporting obligation. The margin requirements form part of the risk mitigation principles under EMIR and were formulated as a means to mitigate counterparty risk in uncleared over-the-counter derivatives. The margin requirements have been phased in, which separate timelines to the initial margin and the variation margin requirements. The obligation to exchange variation margin initially extended to physically settled foreign exchange forwards, as there was no clear delineation between a foreign exchange spot and a foreign exchange forward in the legislation. The variation margin obligation caused substantial disruption amongst the smaller financial counterparties and non-financial counterparties, as they tend to be light consumers of foreign exchange derivatives. The regulatory technical standards on margin requirements offered regulatory relief for firms by delaying the variation requirements for foreign exchange forwards until MiFID entered into force in January 2018. Arguably, one of the changes worth noting is that Recital 21 to the EMIR Refit regulation includes a limitation on the requirement to exchange variation margin on physically settled foreign exchange forwards and swaps between the most systemic counterparties. This could limit the buildup of systemic risk for systemic counterparties such as large banks or investment firms that could trigger severe instability for the financial industry given their size, the level to which they are interconnected with other firms, and therefore pose what we call systemic risk to the financial industry as a whole. The changes also include expanded requirements around the use of internal models for valuation and collateral exchange, where the national competent authorities would have to validate risk management procedures. Key changes to the margin requirements are summarized on this slide. The reporting obligation under EMIR aimed to usher in a new era of transparency in the derivatives market. The dual reporting implementation was vast in scope and content, requiring all counterparties to submit reports for all over-the-counter and ETD derivatives. The reporting obligation also required firms to report key events throughout the life cycle of the trade, daily valuations for FCs, and all collateral and margin exchanges. Given the very ambitious nature of the reporting obligation, it has not been an easy road for many firms to navigate. A number of factors, such as the complexity of the reporting requirements, the lack of nuanced guidance, and inconsistencies between reporting templates from each trade repository, have contributed to difficulties faced by many firms. Following feedback from the industry, ESMA introduced significant amendments to the reporting regime in November 2017. These changes sought to address technical issues, clarify reporting, and align reporting formats between MiFID and EMIR. The changes in Refit are directed towards expanding the EMIR regulatory framework to enable principles identified under the Securities Financing Transaction Regulation, also known as the SFTR, and to streamline the existing reporting requirements. The changes aim, for example, to clarify where the responsibility for reporting lies between an FC and an NFC. Key changes to reporting obligation are summarized on this slide. Thank you for watching.